Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute of every day, we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, and sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You will hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested.
Hi freedom fighters. What's likely to happen in the world this year? What does this mean for global and local equities and property investment markets? And how does this affect you as an investor? What do you do? And what don't you do this year? On the surface, these appear like quite simple questions, but the answers are never easy or straightforward and are increasingly difficult to predict given the complex and growing myriad of interdependent dynamics that are constantly changing at breakneck speed given our global, always connected and always on world that we currently live in. Trying to make sense of it all is like trying to predict the weather, and we all know how well meteorologists do at this despite the intricate measurements and endless data at their disposal. Unfortunately, we now live in a world where the only thing that's constant and that can be confident about is the exponential rate of change in just about everything. The only thing certain is uncertainty. Now, despite media commentary trying to keep us scared, nervous and anxious, I believe there's a growing air of optimism about 2022. Virus vaccine rates are continuing to climb. Businesses that survived 2 years of uncertainty are expanding. The workforce is growing. Border restrictions are easing. International travel is gradually resuming. Immigration's set to resume. We're seeing the great resignation, the work from home and the exodus to lifestyle decentralising how we live and work. And there's a federal election on the horizon. On the flip side, the media in recent times has been filled with stories of a weakening global economy. We've heard about geopolitical tensions with Russian posturing in the Ukraine and the threat of large-scale conflict and or trade sanctions. There's ongoing debate about communist China's slowdown and continuing withdrawal, and the hardening stance on foreign Western trade. There's also ongoing chatter about supply chain disruptions, energy price volatility, and localised wage pressures which mean uncertainty around inflation and its potential flow-on effects on interest rates and lending policies. We've got the prospect of the national confidence disruption and treading water normally associated with the upcoming federal election. And of course, there's the underlying ever-present threat of continued COVID strains, virus variants, and reactive political responses. And of course, there's also the ongoing climate emergency, which means that the probability of major natural disasters remains elevated. All of this at a time when the current economy is unprecedented, with strong growth, rapidly falling unemployment, but also a rapidly rising money supply and growing government and private debt. And all of these are just the tip of the iceberg when it comes to trying to herd the cats and make some sense out of the nonsensical when it comes to making sound investment decisions. So will this optimism last, or will the economic roller coaster continue in 2022? And what are the key economic trigger points affecting investment markets that we need to keep an eye on this year? Well, clearly this is no easy task when we're left trying to contemplate the macro to the micro, given the likelihood and potential impact of a myriad of global and local dynamics. So where does this leave us as investors? Well, instead of listening to the constant deluge of death, destruction and dire straits diarrhea that's flowing from chest-thumping, spotlight-grabbing media commentators who feed on our fear, we need to turn off the noise and turn to wise investment specialists who have a long and proven track record of investment success. And that's exactly what I've been helping you with during the recent summer series, which culminates and concludes in today's chat with Get Invested favourite and regular Pete Wargent, whose credentials across both property and equities in Australia and overseas are second to none. My intention over the summer series has been to give you a variety of views and forecasts from accomplished and recognised investors who don't all agree with each other, but the contrasts enable you to consider different outlooks so that you can make better informed decisions that suit your situation and your circumstance. So before we get into Pete's balanced and unbiased investment outlook for the year ahead, let me share my take on where I think interest rates are going that I talked about in a recent Realty talk show that you can watch in full at realty.com.au. Because, as I've said on many occasions, investment has always been a game of finance that's driven by access to credit, which is greatly affected by lending policy and lending costs. Let me start with a recent nightly news headline. The honeymoon period of record low interest rates is coming to an end, with more than half of economists predicting interest rates will rise this year. Really? Well, this is just one of a bunch of scaremongering media headlines that's occupied our eyes and ears over the last few weeks. So-called self-proclaimed experts have been grabbing headlines with stories of gloom and doom on the interest rate front, following concerns over increases in inflation and the ending of quantitative easing through bond buying, which is really just code for printing more money. Unfortunately, I think the only thing that's overinflated are the media commentators' egos and their interest rate claims. It feels like with every new year there's a new fear to keep us nervous and anxious. The last 2 years have been fear factory paradise, with the endless COVID variants providing never-ending fuel for the far-reaching fear fire. And now that the pandemic appears to be almost under control, as we've just about exhausted variant names in the Greek alphabet, the next best thing to keep us all nervous is to focus our fear of interest rate rises and the flow on to crashing property prices. Haven't we heard all this before? Unfortunately, most predictions and forecasts revolve around the so-called science of explaining tomorrow why the predictions made yesterday didn't come true today. So let me balance the books by having a look at what's really likely to happen with interest rates this year, what impact it'll have on you, and what, if anything, do you need to be doing about it. So let's answer the question, are interest rates likely to rise? Well, the answer is yes. Unfortunately, it's not a matter of if, but the real questions are around when and by how much and how often. Let's start by looking at the worst, best and likely scenarios. The worst case being reported by some self-proclaimed media gurus and has been priced in by futures markets is that rates will rise by 1% by the end of the year, with the first increase in the cash rate from 0.1% to 0.25% occurring as early as May and then rising bi-monthly over the course of the year up to 1% or more. Now remember that the cash rate is generally roughly 2.5% below actual home loan rates. So this would mean an increase in average variable home loan rates from about 2.5% up to 3.5% over the course of the year, which doesn't actually sound like much when you consider this in the context of overall interest rate history. Now, the best case, on the other hand, is that the Reserve Bank Governor will stick to his guns when he stated repeatedly at the start and during the COVID crisis in his forward guidance that rates would remain on hold until 2024. Now, the likely case is likely to be somewhere in between, and in my own humble opinion, rates will remain where they are until at least late this year at the earliest, and will only then rise marginally and slowly, depending on the impact of a bunch of economic variables. What's this based on? No, not on gut feel or reading the tea leaves, or trying to be a sensationalist headline hero, but listening to recent actual comments from the person who's in charge of making those cash rate decisions, the Reserve Bank Governor, Philip Lowe. Having listened in full to his year ahead speech that he made recently, he made it very clear that the Reserve Bank is in no hurry to increase interest rates. So let me share with you his key statements that help me draw this conclusion. Governor Lowe started with shared optimism, where he said, "Our economy has weathered the pandemic much better than was expected. Job growth is strong and unemployment is low. Household and business balance sheets are generally in good shape, and wages growth is picking up. These are all welcome developments." But here's his scene setter, where he said, "At the same time, though, the country faces challenges. The pandemic's not yet behind us, and the sharp pickup in inflation in some parts of the world, particularly in the United States, has added a new element of uncertainty to the outlook." He then goes on to talk about our continued recovery, where he said, "While Omicron has delayed the recovery of the Australian economy, it hasn't derailed it. That recovery is being underpinned by a number of factors. These include household balance sheets that are generally in good shape, with households having accumulated more than $200 billion in additional savings over the last 2 years. An upswing in business investment is also underway, and there's a large pipeline of residential building to be completed over the next year or so. Macroeconomic policy settings are also supportive of growth, with governments planning significant infrastructure spending, and monetary policy is very accommodative. Australia hasn't experienced unemployment rates this low in the past half century. The last time we had the unemployment rate below 4% was in the early 1970s. Now, this is all very positive news. So let's now turn to the subject of inflation or rising prices, which is sparking the media's negative pessimism on interest rates. The RBA governor said that the pickup in inflation reflects both the strength of the economic recovery and, here's the real crux of the matter, the significant disruptions on the supply side. As we all know from our high school economics, the cost of anything is the balance between supply and demand. And over the last 2 years, we've seen a massive increase in demand from all of the stimulation money that's been poured into the system. And while world supply has been strangled to a dribble due to COVID transportation restrictions and slowdowns. Governor Lowe then went on to say, headline inflation in particular has been boosted by the 32% increase in petrol prices over the last year and the 7.5% increase in the cost of constructing new dwellings. Looking ahead, we expect underlying inflation to increase further over coming quarters, largely reflecting the ongoing difficulties on the supply side, including currently from Omicron. And again, here's the kicker when he said, as these problems are resolved, some moderation in inflation is expected. This suggests that the current kick in inflation is only temporary as a result of abnormal supply and demand conditions created by the global pandemic. He then expands on this further when he said, on the inflation and wages fronts, there are also a range of significant uncertainties. These partly stem from the uniqueness of the period in which we're living. Over the past 2 years, there has been very strong demand for goods globally, just at the time that the ability of the economic system to produce and distribute goods has been impaired. In other words, what he's saying here is that there is significant temporary demand with limited ability to supply. He then went on to say, the strong demand colliding with impaired supply means higher prices and higher published inflation. It's still unclear as to whether and at what pace the demand for goods will normalise as infection rates decline. There's also uncertainty as to how quickly the supply and distribution problems will be resolved. He then reinforces the potential temporary nature of recent inflation rises when he concludes, "We can't rule out the possibility that some of the recent price increases are reversed as a more normal balance between supply and demand is re-established. In any case, for inflation to be sustained at current rates, the prices of many goods would have to keep increasing at their recent rates, not just settle at higher levels. All of this means that there are significant uncertainties as to the persistence of the recent price pressures." He then makes a critical conclusion when he said, "The point here is that there are many unanswered questions. We're unlikely to know the answers quickly. There are many moving parts on both the demand side and the supply side of the economy, and it will take time for these various issues to be resolved." This is relevant to the board's deliberations about monetary policy. Now, my reading of this is that the RBA is in no hurry to make any knee-jerk changes to temporary disruptions until things settle down. He then turns his attention to ongoing Reserve Bank monetary policy, and he said, "The cessation of our bond purchases, which is called quantitative easing, does not represent a tightening of monetary policy." And drilling down into rate expectations, he clearly said, "The decision to end the bond purchase program does not mean that an increase in the cash rate is imminent." Now, that's a pretty clear statement. And with this background, RBA Governor Lowe finally addressed interest rates, where he clearly stated, "As I've said on previous occasions, the board will not increase the cash rate until inflation is sustainably within the 2 to 3% range." He went on to explain, "The actual rate of inflation is relevant, as are the trajectory and the outlook. So too is the breadth of price increases and the factors driving them. Based on the evidence we have, it's too early to conclude that inflation is sustainably in the target range. In terms of underlying inflation, we've just reached the midpoint of the target range for the first time in over 7 years. And this comes on the back of very significant disruptions in supply chains and distribution networks, which would be expected to be resolved over the months ahead. It also comes at a time when aggregate wages growth in Australia remains low and is at a rate that's unlikely to be consistent with inflation being sustained around the midpoint of the target range. As I discussed earlier, there's a range of significant uncertainties here that will take time to resolve. We're in the position where we can take some time to obtain greater clarity on these various issues. The board is prepared to be patient as it monitors the evolution of the various factors affecting inflation in Australia. We have scope to take the time to distill the balance between supply and demand in the economy. Over the course of this year, we'll be watching how the various supply-side problems resolve and the effects on prices. We'll be watching consumption patterns and whether they normalise. We'll also be watching for further evidence that labour costs are growing at a rate consistent with inflation being sustained within that target range. We expect this evidence to emerge over time, but it's unlikely to do so quickly. So, what's the very clear take-home from the RBA Governor's speech? The Reserve Bank is going to be in no hurry to raise interest rates anytime soon, until they're confident that underlying inflation is sustainably in the 2 to 3% range, which means consistently over time, not just the one-hit wonder that's just occurred. So why keep interest rates low if the outlook is so positive? Well, the RBA Governor put forward 2 clear reasons. Firstly, while the Reserve Bank has an optimistic outlook for the year ahead, there's still a great deal of uncertainty around what the year's going to bring. The bank wants to make sure that economic gains are locked in before it takes its foot off the accelerator. The costs of overheating the economy are actually relatively minor compared to what could happen if it hits the brakes by raising rates too early and a new COVID variant tips the economy back into a recession. Secondly, the current big handbrake is that wage growth remains very weak. The economy won't be on a stable upward trajectory until wage growth picks up from its historic lows. And although the RBA expects wage growth to lift, it believes it'll be a while yet before it climbs above the minimum of 3% needed to keep inflation within the target band. Hence the reason why I believe the RBA's cash rate and related home loan interest rates aren't likely to go anywhere at least until late this year and potentially well beyond. Add in the federal election in the first half of the year and ongoing potential COVID variant responses, and you can be confident that rates are likely to stay where they are. And there are also some other underlying reasons why rates aren't likely to increase fast, as revealed recently by respected economic commentator Alan Kohler on the ABC. He said that the reality is that the last rate increase was way back in November 2010. That's over 11 years ago. And since then, over 1.1 million first-home buyers, many of whom have borrowed to the max, have only seen rates decrease. And during this decade of cheap, low-rate money, our appetite for debt has increased substantially, with the debt as a ratio of our incomes climbing from 0.6 in 1991 to 1.8 in 2021. That's an increase of 3 times the debt to our income. And even more interestingly, when the last rate rise occurred in 2011, the average mortgage was only about $360,000, with repayments at approximately $2,700 a month, based on variable home loan rates at the time of about 7.5%. Now, the average mortgage today has almost doubled to just over $600,000. And if home loan rates increased over the next few years back to that 7.5%, which is actually the average home loan rate over the last 30 years, repayments would increase to over $4,400 a month, which is an increase in repayments of over $1,700 a month. Now, to service this increase without affecting your lifestyle, your taxable income would have to increase by about $35,000 gross a year. But the average annual wage has only gone up by about $13,300 a year since 2010. So this increased debt burden to you and I, together with the massive debt that the government has taken on during COVID, means that it'd be very difficult and risky for the RBA to normalise interest rates back to those historic average levels without creating major economic challenges to household spending and general confidence. This would be a recession in the making, and hence my belief that low rates are going to be with us for some time yet. So, in my opinion, we can all calm the jets on interest rates going through the roof in the short to medium term. But one thing is for certain, the next move in interest rates, when it eventually does occur, will be up. And the banks may decide to lift their variable home loan rates marginally independent of the Reserve Bank, although recent downward movements in variable rates tends to offset this given the competition in the banking sector. So, what, if anything, do you need to do about the future prospect of rising rates regardless of when it occurs? Well, the answer is always, it depends. It depends on your situation and your risk appetite. Now, I'm always a believer in planning for the worst and then expecting the best. So if you're a current homeowner who's looking to minimise your home loan repayments, I'd suggest sticking with discounted variable rates. But make sure you talk to a savvy mortgage broker to ensure you've got the lowest cost loan. As an example, our know-how finance mortgage broking team is currently saving borrowers anywhere between $400 to $1,200 a month just by refinancing. Now, if you're a home borrower who can't deal with uncertainty and you need to lock in your costs so you know what they are, then I'd suggest splitting your loan by fixing part of your loan, even though fixed rates are now considerably higher than variable at the moment. but leave an amount variable so that your offset account still operates and you're still able to make extra repayments, because most offset accounts cease to work when you fix the rate. If you're a renter who's looking to become a potential home buyer in the next couple of years, start paying notional rent at the level of a higher mortgage, with the extra that you're paying going into a savings account to ensure that you'll be comfortable affording the increased repayments when you actually do buy a home, and at the same time, you'll be increasing your savings deposit. And finally, if you're a property investor, make sure you reach out to a savvy mortgage broker to ensure that your loan structure and loan costs are minimised while preserving maximum tax deductibility, because the structuring of investment loans is an art and a science, and not many bankers and not many brokers are good at making that happen. In summary, the next move in interest rates is likely to be up, but it's not likely to be by much and not for some time yet. So stop listening to the mass hysteria media and always get your information straight from the horse's mouth, not a whispering wall. Enough said on inflation and interest rates. Let's now turn our attention back to a broader outlook on the year ahead in equities and property investment markets to help you make better investment decisions in the conclusion to our summer series by enjoying the always informative and engaging views of this week's regular guest, Pete Wargent.
Hi, freedom fighters. Now, as the world starts to cautiously emerge from the isolating darkness and variable fortunes of the global pandemic, investors of all types, varieties, and asset classes are left wondering what lies in store for the year ahead. And with continued uncertainty being the only certainty, and asset prices of all types at or near record highs, how do you predict the weather of investment markets to see where equities and property are likely to be heading in order to enjoy the rewards while managing the risks? Well, for me, it's always been about turning to someone who's been there, done it, and seen it all before. And the best person in the country, in my humble opinion, to give you the facts versus the fiction on all of this is Get Invested regular Pete Wargent. And as well as being one of Australia's brightest financial minds, Pete's well known to us here as a 6-time published finance author. He's a leading investment analyst on the back of his work as an active investor in equities and property. He's a buyer's agent, a strategist, and a mentor. And he uses all of this, incorporating in tried and tested strategies to assist you in achieving your financial goals across the broad spectrum, can't even talk today, the broad spectrum of property and equities. And to help property buyers level the playing field in our very current hyper-competitive sellers market, his national buyer's agents business, Buyers, is harnessing the knowledge of Australia's leading buyer's agents at a price every Aussie home buyer can afford in order to secure quality properties. And that, along with his partnership with Steve Moriarty, is helping equities investors with their next level wealth venture. So that's quite a mouthful, mate. That's taken up half the podcast just introducing you, but welcome back and let's get invested, Pete.
Wow, what an intro. Thanks, Bushy. I hope I live up to the billing because that's quite a roll call of things to live up to. So let's see how we go.
Mate, you've done it. You've earned it. You've got the stripe. So I don't think you need to live up to anything, mate. But Pete, just to kick things off, given you're a bit like an octopus, you've got fingers in a lot of pies. Can you sort of give us a bit of an update on what you're currently focusing on, and in particular, what's happening with both buyers and next level wealth?
Yeah, so I guess the big story at the moment is inflation. So it's not something we've really had to talk about for maybe a dozen years. And now suddenly, I guess because of two reasons. Firstly, governments around the world have pumped fiscal stimulus into economies. Well, it's really three reasons. Central banks around the world have also been printing money like it's going out of fashion. And then the third reason, so with all of the disruption from COVID, supply chains around the world have been completely clobbered. So suddenly now we're getting price inflation and wages growth. So it's a real change from what we've got used to over the past decade. So what does that mean for markets? Well, in the property space, I guess we're starting to see in some parts of Australia, rents are going through the roof. Southeast Queensland, I've seen places where rents have gone up 50%. It's the same, though, if you try to call out a tradie, just getting an aircon fix or something like that. I mean, the prices have gone through the roof. So it's not in every part of the economy, but inflation is the big thing. What does that mean for markets? Well, it probably means interest rates will start to rise finally. So that does have an impact on mortgage rates and potentially some negative impacts for the stock market as interest rates and the cost of money rise. Well, that could just put the cat among the pigeons for the more expensive stock markets around the world, particularly the US.
Great overview to sort of hit all the headlines. So thanks for that, mate. What I'll be keen to do to sort of put all this in context, and then we'll drill down into some of those a little bit from the global to the national to the local level. Can you sort of give us a bit of a rundown on your review of last year and what we've learned from it and what we need to take from it that's going to be applicable to what lies ahead?
Yeah, so I think certainly early on in the pandemic, there was a huge amount of uncertainty. Governments stepped into the void, I guess, to pump the economy full. Eventually, we started to get some kind of agreement what the virus meant, the mortality rates and so on. And of course, the big game changer was vaccines. And once financial markets and once individuals realized that this wasn't going to go on forever, well, then things turned. Markets started rebounding. Property markets did probably 20% last year. Cases more. Stock markets also rebounded from the lows. So I guess, it was a game of two halves, so to speak. A lot of uncertainty followed by confidence returning. So now the focus really is on what will governments do in terms of winding back the stimulus and the central banks as well.
Yeah, no, a good call. I think for me, and it continues to be highlighted, all of the normal mass media forecasters were, again, a long way out in relation to the reality versus the fiction that they were looking to promote. And certainly, we saw a once in a generation sort of stimulation exercise with buckets of money, low rates, and nowhere to spend it. So property is certainly a big winner out of that exercise. There was certainly the regionalisation spread and pretty much all properties right across the country enjoying that sort of buoyancy. But as you say, the rental squeeze that's sort of starting to emerge and the cost of doing anything and the supply restraints have certainly set things up for a pretty interesting year. So sort of looking to the future then, Pete, and let's start at the sort of global macroeconomic level and then start to drill down to get down to what it means to equities and property markets. What are you seeing as the major factors, drivers and dynamics over and above the inflation that you've already mentioned that are most likely to influence or affect equities and property?
Well, it's really the cost of money. I think that's the big one. I think the Federal Reserve in the US will now start to hike rates probably from around March. There is some debate about whether they might actually skip doing 0.25% rise and maybe go straight to 50 basis points. I don't think that will happen, though. I think one of the key lessons over the past dozen years is that once central banks have cut interest rates to zero, well, there aren't many good examples of them getting away from that. Now, we've tried a few times, but I remember interest rates back in the UK going down to zero in the global financial crisis. Well, we're still near enough at zero now, and that's a dozen years on. Same could be said of the United States. They did have a go getting interest rates off zero, but now we're back at zero again. So I think people are getting very excited about the prospect of rising interest rates, but all of those factors that caused low inflation and low interest rates in the first place haven't really gone away. So of course, interest rates will rise from here. They have to. They're at the lowest level in history. But I suspect they won't go as high as some people think they will. And I think rate hikes will be delivered in a gradual and very considered manner, because what's the point in pushing global economy back into recessionary territory, given that the efforts that were made to avoid it in the first place?
I totally agree, mate. And I sort of dissected with a microscope Philip Lowe's RBA speech last week before I sort of made my own commentary on where rates are heading. And he's made it really clear that there's a lot of uncertainty, which means they're going to be very cautious. And the thing that I took away from his speech is that they've got time. We can be patient. We can sit back and look at whether these supply chain issues are transitory and its flow-on effect into inflation. So there's no rush to have to do anything. So while again the media has been ramping up the fear factor around interest rates jumping through the roof and rates starting to rise as early as May and potentially 1% over this year, I'm not seeing it, mate. I'm going to be very surprised if we see much movement at all until late this year, if at all, and then only fairly incremental change, given the fact that the sustainability piece around inflation and other bits and pieces is yet to be proven. What's your read of that?
Yeah, totally agree. Now, I guess America is the canary in the coal mine, or the lead indicator, or whatever you want to call it. Inflation is very high at 7.5%. But I think you'll find that although inflation will be very high in the first quarter of this year, I mean, there are some factors in there, without getting too technical, relating to the index weights. And I wouldn't be at all surprised if by the second quarter of the year we see disinflationary forces returning, and suddenly all this narrative about interest rates spiking will actually become a bit of a fizzer. So look, I tend to agree. The Reserve Bank in Australia is not in a rush to hike interest rates because inflation is only 2.6% on the underlying measure. So why would you rush to hike interest rates when wages growth is still so low? So look, they might be penciling in a hike later in the year, but yeah, I mean, let's face it, we're talking about the cash rate at 0.1%. If we get a hike or two, well, big deal.
Totally agree.
I don't think it's really going to move the.
No, 100% agree with you, mate, on that score. Let's have a look at some of the other international impacts, and I guess I'm keen to get your read on the Russian situation and the Chinese situation. What's your read on the impact of any of what's happening in those parts of the world in relation to its impact on the local share and property markets?
Well, yeah, China is very interesting. People have been talking about the China credit bubble for, I guess, the past dozen years at least. And we've seen one of the country's biggest property developers, Evergrande, having a debt default. So there's a lot of sort of international concern, or there was, about what might be the knock-on impact of a default. I think you never really know with these things about the dominoes that could be tipped over, but I suspect it's not the same as a bank going bust like Lehman Brothers back in the global financial crisis. It's a property developer, but also I think some lessons have been learned about allowing default to tip into contagion. And also, I mean, the Chinese government will most likely restructure things, is my guess. I mean, what does it mean for Australia? Well, I guess potentially some Chinese stimulus, which is good for iron ore and coal exports from Australia. I think the thing that's actually probably of more relevance to property in Australia is we've had a very good or relatively good relationship with China over recent years, particularly during the Rudd years, famously speaking Mandarin and courting the Chinese relationships. That's soured somewhat. Yeah. So will we see the return of foreign buyers in Australian property? International students, well, China was the number one source of international students previously. And also, if you set aside New Zealand, which isn't really the peak source of tourism spending, that's a lot of short-term arrivals. I mean, China was the number one source of international tourism spend as well. So I think that's the bigger thing. Will Chinese skilled migrants, international students, tourists, will they start to come back again? Because if so, obviously that's very positive for the Australian economy, also for property potentially. The relationship is on rocky ground at the moment, partly because of what's been happening with the Americans. So yeah, look, the Evergrande situation seems under control at the moment, but who really knows? Australia's relationship with China, not sure. And as for Russia and Ukraine, well, it doesn't look good. I'm not an expert in geopolitics, but I guess we've been through a long period of globalization, and that now does seem to be fracturing. So some implications there for economies like manufacturing and so on. But at this point, it doesn't look great, it must be said.
Yeah, okay. Well, sort of putting those two aside because they're sort of wild card exercise to some degree. Are there, on top of what you've already mentioned, are there any other economic shifts or emerging trends that you believe are likely to impact on equities and property markets in the year ahead?
Well, lots of potentially smaller factors. I think in Australia, it's obviously an election year, which I guess usually puts things on hold for a short period of time while people work out what's happening. It's not going to be the big market mover like it was 3 years ago for real estate, because this time around, the Labor government's not going in with a raft of proposals that they're going to make themselves a smaller target this time. But it does tend to sort of gum up markets for a while people work out what's going on. So, yeah, I guess, there's domestic factors. Lots could happen internationally because I guess in the end, we still haven't seen the back of the virus globally. So there could be all kinds of sort of impacts from the coronavirus. But yeah, we'll have to wait and see. As you said, the predictions last year turned out to be horse shit. So quite possibly again this year too.
Totally agree. So that's on the emerging trend side. Are there any other risk factors that you're identifying that investors need to take into account in their investment strategies in 2022?
Yeah, look, it depends on personal circumstances. I think if you look at, certainly in historic terms, the US stock market is valued very richly, shall we say. And I guess what we do know over the past 20 years is if the US market takes a tumble, then pretty much every other market will do the same thing. So I guess there's certainly, in the short term anyway, there's some potential risk of a correction, but I suppose you could say that's always the case for stocks. It's just important to know what your strategy is. And for real estate, well, I guess there are some pockets of the market where there's been some over exuberance, and if people start shifting back towards the capital cities, maybe some of those areas where people have paid, shall we say, crazy prices, particularly for B and C grade assets, well, yeah, there could be some risk there. But I guess overall, look at the forecast. The Reserve Bank sees unemployment potentially falling to 3%, lowest we've seen. So I guess from that point of view, pretty rosy. So let's hope for no sort of black swan events or curveballs.
Yeah, totally agree. Let's touch on regionalisation while you're there, because I'm sort of starting to hear a bit of banter around what I'm calling the boomerang effect of, that people have decentralised to the regions because of the whole fear factor around COVID. But there's a lot of punters now suggesting that trend's going to reverse. What's your read on if and when and what impact that might have if it in fact is going to happen? What's your read on the boomerang of the regions back to the cities?
Yeah, well, certainly anecdotally, the CBDs I'm literally talking in the past week at the time of recording, suddenly just got a bit busier again. Certainly through January, very, very quiet. A lot of people were either working from home or staying away. So yeah, look, I think the future is more similar to what it was than people think at the moment. I think, some of the regional shift will persist for sure. I mean, I live regionally myself these days, and I know plenty of others who do.
Me too.
Yeah, but by the same token, you can see the investment in office assets happening again, and businesses starting to want people back in the cities. I think one of the things demographically in Australia is that new migrants go to the capital cities. 90% of them do. And of course, that just hasn't happened for 2 years. Internally, people tend to move to Southeast Queensland largely, but it's the new migrants that go to Sydney and Melbourne that have been missing. And I guess that's about to resume forthwith, probably quite soon now as border restrictions are removed. So I think Sydney and Melbourne will continue to thrive as global cities, but internally, some of those regional cities, particularly on the coast, I think the popularity will persist.
Yeah, well, you sort of mentioned a great segue into the opening up of our borders and potential immigration starting to occur again. We're already seeing a major rental squeeze right around the country, with the exception perhaps of apartments in the CBD, but even those are starting to get chewed up. What's your read on the impact of opening the borders and immigration on property and equities as we move forward this year, Pete? 2 words,
rental crisis. I think the January figures showed the vacancy rate nationally falling from 1.6 to 1.3%. That's a huge decline in a month.
Yeah.
Lowest vacancy rate we've seen in 16 years. I mean, you only need to look at those figures on a month-on-month basis. They're only a couple of months away from, near enough zero rental stock. I think the Reserve Bank actually did a paper in 2017 where they were analysing the housing turnover rate. And one of their observations was that new arrivals into Australia don't buy property. They tend to be renters initially, particularly international students, but actually skilled migrants as well. I think back to my own journey. When I came to Australia, of course, I would have loved to buy a property, but I didn't know where the hell I was going to live, didn't know how the system worked, So, of course, initially people tend to rent.
Yeah.
So borders reopening February 21 for visa holders, and then more so for skilled migrants going forward. And investors, particularly portfolio investors and landlords, it's been so difficult to get access to finance unless you've got a good mortgage broker such as yourself. So I can't really see any way that we don't end up in a rental crisis. And in some markets like Noosa, I've seen rents going up, like in some cases 50%. Well, imagine that in many more pockets around the country. I think, as you said, the CBDs have been fairly quiet now for a couple of years. So those markets have got some filling up to do, but almost everywhere else, except for Darwin, rental vacancies are just getting tighter and tighter.
Yeah, totally agree. And it's not something you can solve quickly. With the government repeatedly washing its hands of any responsibility for the supply side of the housing equation and leaving it totally in private hands to pick that up, given the constraints around that, we're likely to see that rental crisis in play for quite some time to come, I think.
Yes, and if you think back to the global financial crisis, rents they tend to move not very much for a long period of time, and then suddenly they spike, and that's what we saw in 2009. In Sydney, rents hadn't really done much for ages, and then suddenly in the popular locations, suddenly rents just went crazy, and that's what we're seeing again in certain markets. And as you say, there is a real lag time in terms of construction of new apartments, getting more investors into the market. And now we've got this big flood of new arrivals coming. Well, we've got 2 years backlog of new arrivals who are suddenly going to be queuing up at the border. So, we'll have to wait and see. But I think rents will be probably up 10 to 20% nationally this year.
Yeah, totally agree. Okay, well, putting all of that, all of those ingredients in the recipe, I'd love your thoughts then on your outlook for both equities and property in the year ahead, particularly in the context of, again, some fairly gloomy outlooks from a lot of the bank economists who are suggesting that we'll see much reduced growth in the property sphere this year and declines in 2023. With that as a backdrop, what's your read of what's likely to happen in both equities and property in the year ahead, mate?
Well, those are the same guys who are predicting 20 and 30% declines during the pandemic. So I wouldn't pay too much heed to predictions of what will happen in 2023, particularly some of the forecasts that are done to one decimal place, which is always somewhat ridiculous. I mean, look, best guess, I would say 5 to 10% growth for property this year. 2023, I mean, who really knows that far out? I think on the stock market side of things, it's a bit of a running joke. The economists always put out their annual forecasts, and most of the time they're somewhere near, and then there'll be 1 year every so often when they miss by 30% or something. I mean, you can't really predict equities over a 12-month time frame. If you could, you'd be very wealthy. Usually, I mean, you can look at longer term indicators, like, for example, the CAPE ratio in United States, which is at 36. I mean, there's a very strong correlation between the 10-year CAPE ratio and returns over the following 10 years. And at CAPE of 36, that kind of implies returns of about 3% per annum over the next 10 years, and probably sounds reasonable. Very expensive markets, but the other markets around the world aren't as expensive, particularly in some of the emerging markets. So look, it depends where you're looking. Australia is kind of in the middle, and I guess the outlook for commodities is pretty good. So Australia, from that perspective, might be pretty well placed.
Yeah, totally agree. Stepping back from that, and this is where there's a real risk of getting very myopic and reacting too much to what's happening right here, right now. I know you and I have talked about this before, and we have similar beliefs on this in terms of adopting overarching investment principles and approaches that don't get caught up in the minutiae of what's happening today. Can you share some of those with us? Because I think by adopting that sort of universal approach and a much longer time frame approach, it means that you don't need to get too nervous or anxious about what's happening today.
Well, yeah, that's more or less it. You've got to map your investment time horizon, and then I guess if it's a long one, which for most people it is, then you need to expect that there'll be ups and downs along the way. I think saw a video with Charlie Munger where he said, if you're investing for the very long term, there could be periods where stock markets are down 50%. You've got to take a long-term view and actually understand what your strategy is. So, yeah, for most property investors, it's not very suitable asset class for a 2-year time horizon because of all the costs involved. So for most people, it's taking that longer term view. That's understanding the fundamentals and adopting an investment approach and mindset that reflects that.
Yeah, no, well said, mate. Absolutely well said. And I know that giving one of your other podcasts a big plug, the podcast that you do with Steve Moriarty is a cracker for those on the equities front in terms of adopting that much longer term approach. And almost, you don't have to be playing in the game if the prices aren't right. You sit back and wait for the conditions to be right and then jump in. So patience is a big part of that, and a similar sort of approach on the property end. Mate, given us a really good primer on what we're playing with and where that's heading. As we close, then I'd love for you to give us an update on what's happening with buyers, and what's happening with Next Level Wealth for those that might be interested in reaching out to you on either or both fronts.
Yeah, so Buyers is Australia's first genuinely national network of buyers agents. So we provide affordable fixed fees for service, and we have a range of products for all circumstances and all budgets. So ranging from the full traditional end-to-end service right down to a much more affordable negotiation and due diligence service. And for people who don't know what steps they should be taking next, we do have an affordable 10-year property plan strategy service. And we don't have any vested interest in whether people should invest in any particular state or city. We can give fully independent strategy advice. So I guess it's a fully national service, and that's something that we do that is quite different to anybody else out there. As you mentioned, we do also do a podcast called Low Rates, High Returns, which is much more focused on the stock market and equities. I do that with Stephen Moriarty. And we do some mentoring and coaching services at Go Next Level Wealth. So you can track that down at gonextlevelwealth.com.au. So a couple of places to track me down. But if you go to petewargent.com, you'll find out plenty, probably more than you want to know about me.
Well, just in closing there, mate, I'm going to be suggesting that everyone listening plugs into your latest Pete's Property podcast, which is a great listen, and you've been brave enough, and some would say stupid enough, to have me on as a guest. So really enjoyed that, and the Low Rates, High Returns podcast is a great listen if you're wanting to really educate yourself on a sensible approach to equities investing, which it's quite refreshing in that regard, mate. So look, always love having you on, mate. We'll continue to do so. You have that objective, unbiased, transparent view, and you call it how it is, which is also pretty rare in the industry. So appreciate your time on the show today, mate.
Always a pleasure. Thanks, Bushy.
Thanks, mate. Bye for now.
To get a summary of all this investment gold in the show notes, just email me on hello@khgroup.com.au. That's HELLO@khgroup.com.au. Or check us out at www.bushymartin.com.au/get-invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening, and as always, dream as if you'll live forever and live as if you'll die